Welcome back friends to the class number 82. In the previous videos, we have discussed the cash credit, overdraft, drop line overdraft, temporary overdraft, ad hoc facilities, which were basically the working capital financing facilities. And now in this video and the coming 3-4 videos, we will discuss about various types of term loans that are prevailing in the banking system. So starting with machinery term loan from this video. So machinery term loan, as you understand, it is given to you for purchasing the machinery for your business, right? So the purpose of this capex, purpose of this loan is ultimately capex, capital expenditure. The machinery that you are buying is a capex in your books of account. So why I have written capex here? So suppose you are doing trading of machinery or suppose you are doing manufacturing of machinery, then you cannot take machinery term loan from the banks, because machinery that you are dealing with is your goods practically, which represents your stock, which represent your current assets, and for that you need cash credit or overdraft facility. But when you need to book fixed assets in your account, in your books of account, then if you want to buy machinery, then only you have to take the machinery term loan from the banking system. So what is the end use of this loan? The end use is for purchase of machinery, right? So you also need to take the end use certificate, CA certificate, after buying the machinery for as a compliance requirement for the banker, right? The machinery term loan, it is a fixed tenure term loan given to you. So the repayment of this loan is EMI based. You have to pay the monthly EMI, monthly repayments of principal and interest to the bankers, right? So for how much period? The tenure. Generally, the machinery term loans are given for maximum 7 years period. Some banks are giving it for 5 years or 3 years. Up to 7 years is generally the maximum tenure of machinery term loan, but it all depends upon the internal policies of bank to bank. So that 7 years tenure, friends, include the moratorium period also. That 7 years period includes the moratorium period also. So what is moratorium? So moratorium means, so suppose you are buying a machinery, and you expect that this machinery will increase your production and it will increase ultimately your sales and your profits. So after increase in sales and after increase in profits, you will be having some cash flows in hand, which will be helpful for repaying the EMIs of machinery term loan, right? So suppose you are buying machinery on 1st of April, you are taking machinery term loan, you are buying machinery on 1st of April, and then machinery comes to the factory, it gets set up, you start production with the machinery, the production, and then you have to keep the minimum inventory in the factory, then you sell the stock, then you take time to recover the payments from your debtors. So it may be possible that you need support for 4-5 months, maybe 6 months, or maybe in some cases even 12 months period from the banker, saying you will be saying to the bankers that I will not be able to pay off the principal amount during that period, because it is the initial setting up period for my business, because the machinery sales and its cash flows generation will take a certain amount of time, right? So in that period I will not be able to pay any principal amount to you, right? So in that period the banks may allow you to pay only interest amount. They can allow you to pay the principal amount after the end of the agreed period, 6 months or 12 months or 3 months, whatever the agreed period may be. So principal amounts repayments will be start after that 6 months period, right? So that 6 months period is, friends, called moratorium, right? So the moratorium can be of principal amount and can be of both principal and interest. You can also debate with the bank that I will not be able to pay the interest amount also. So kindly allow me the moratorium for interest amount as well. I will pay you both principal and interest after 6 months period from the date of taking machinery term loan. But the moratorium of both principal and interest is rarely allowed by the bank. Generally, it is not allowed. The moratorium of principal amount only is allowed by maximum bankers, generally up to 6 months, but it can vary case to case basis. You can take up to 12 months period also, right? So which means during this 6 months period you will not pay off any principal amount, you will only deposit monthly interest to the bankers. So the 7 years period will include the moratorium period also. So in 7 years, there are total 84 months. So you got 84 months to repay the loans, right? And if you take the 6 months moratorium of principal, then I will have to deduct the 6 months here. Then the balance period left is 78 months. That means you have to pay off your principal amount in that 78 months period only, right? That 6 months period shall be included in your total tenure. So how the machinery term loan is disbursed? So machinery term loan is an end use type product in which end use is particularly very closely monitored by the banks. So the machinery term loan payment is directly done to your supplier account. The supplier who is supplying you the machinery gives his account number, IFSC code, and bank pays off the machinery loan amount directly to his account. They do not release that amount into your account, fearing that you may divert the funds elsewhere, you may not buy machinery after getting the funds into your accounts. So that is why they prefer sending the funds directly to the supplier's account. There is one another thing that they can do. They can do reimbursement to you as well. You can say to the bankers, you can say to them, I have bought the machinery 3 months back, and I have made the payment on my own account. I have made the full payment on my own account. I have not taken any finance. I have done all the payment by myself for that machinery. So you will submit the proof. The bankers will check from the bank statement. They will take the CA certificate. They will take the copy of invoices as a proof that you have actually bought the machinery and you have actually not taken any loan, and you have actually paid the machinery payment, full payment from your account, right? So after satisfying, the banks will reimburse the amount to your account. The bankers will say, okay, we are overall comfortable on your profile. You have bought the machinery. We have taken the proof. You have made the payment to the suppliers. Now we don't have any option to make the payment to the supplier's account directly. So we can reimburse the amount into your account, right? So this option is also available in the market. But the question is, how much old machinery can be financed like this by the bankers? If these circumstances are allowed, by the bankers, then you may go to the bank and say, see, I have bought machinery 2 years back, so kindly reimburse the amount that I have spent on the machinery 2 years back. No, there must be a fixed timeline up to by which period your machinery which you have bought by your own funds can be reimbursed by the bankers, and that period is generally 6 months or maximum 12 months period. So 6 months period from the date of your current request, right? So suppose today is 1st September. So you are requesting bankers for machinery term loan, and they have sanctioned the machinery term loan to you. So they will see 6 months back from 1st March to 1st September, whatever machinery you have bought in these 6 months period can be reimbursed. That period can also be 12 months. So friends, I let you know that some NBFCs, I will not name them, they are allowing even 2-3 years period also. So they will reimburse you only 75% of the amount, since 25% is your own margin. So suppose you have bought machinery of rupees 10 lakh, you have made payment of rupees 10 lakh, then banks will reimburse 7.5 lakhs into your account. So that was what I was explaining. The margin in the machinery term loans are 25%, and CA certificate of that margin is also taken. That 25% should come from your own sources, or from your internal profits, or from your fresh capital infusion. For that, the CA certificate as a proof is taken by the bankers, and they also check the bank statement in case you infuse the 25% from your own account as a capital. So the assessment is machinery term loan is based on the DSCR only. The security in machinery term loan, the primary security is the exclusive charge hypothecation of the machinery, that is exclusive charge, and banks keep the original bills with themselves. And secondary security is immovable property, which is taken by majority of the bankers. But there are certain organizations like SIDBI, like Bajaj, and some banks also have policy to finance the machinery exclusively on the primary security only. They don't take any secondary security or any collateral security from you separately. But many banks take separate immovable property as a security also. So what are the key underwriting points? Just remember, friends, second-hand machinery is generally not financed by the bank. Again, that is their own call, but generally second-hand machinery is not financed by way of machinery term loan. You should not include the GST amount in your invoice value while requesting your machinery term loan amount. GST amount is not included, although it is internal call, and some banks or NBFCs, I will not name them, they are allowing adding up the GST amount in the machinery cost as well. So the machinery that you are buying must appear in the books of account. The machinery term loan is given for your business. It is, the assessment is done basis DSRA, which is based on your income as per your books of account. So loan should appear in your books of account, and the asset should also correspondingly appear in your books of account. You cannot say that I will take the machinery term loan in the firm and I will buy the machinery in my own individual name and the machinery will not appear in the books of account. You cannot say that. So the machinery quotation, initial quotation, you have to submit prior to sanction of the loan. As a credit manager, you have to deeply understand the impact of new machinery that your borrower is going to buy, how it will enhance the capacity, will it modernize the existing machinery, or will it enhance the existing capacity, will it produce new items or will it produce existing items only, what will be the impact of machinery on the coming periods sales and profitability, right? So all these things you need to deeply understand from the borrower. When bank is not taking any secondary security, when they take only machinery as only security for their machinery term loan, they are not taking any immovable property, then they become extra cautious because they don't have any fallback plan. They have only machinery which is also lying in the factory of yours. Bank doesn't have any control over the machinery. So when they take only primary security and don't take any secondary security, they become extra cautious. So in that case, bankers send confirmations to the vendors as well. The vendors, the suppliers who are supplying you the machinery, will get a confirmation mail or request mail from the bankers asking them the details about you, the details about the machinery that they are going to supply, by when they are going to supply, just to make sure that the whole transaction is genuine transaction. And some banks or NBFCs also do proper due diligence of the vendor. I remember a case where I got a loan sanctioned for my client from an NBFC, and later on the NBFC, when I asked for the disbursement, the NBFC said that we have done the due diligence internally of your vendor, and we saw that he has a very small shop in a very backward area. The business premises were even logged at the time of our visit. And we have checked his financial numbers and market reference as well. He is not doing the business properly, or if the numbers are not sound enough to supply this kind of machinery, so we are not comfortable on the vendor of your borrower, so we will not give any disbursement to you. So they do the due diligence of vendors as well, right? So while some banks also take the report from the chartered engineers as well. So the chartered engineers are the technical persons. When the machinery comes in the factory, they go to the factory, or they check the machinery, they check whether it is a new machinery or not, whether it is the same machinery which was asked by the borrower or not, right? So they give all that confirmation to the bankers. For project financing cases, some banks apply DSRA condition as well. So debt service reserve account, DSRA means debt service reserve account. So it is basically a security for the bankers. So suppose your monthly EMI is 1 lakh rupees per month, 1 lakh rupees per month, and you are setting up a new project, and bankers are not sure whether your project will run successfully or not. So the bankers will say, we are not much sure on your project successfulness of your project. So let us kindly give us the DSRA of at least 6 months, which would mean that 6 months equivalent EMI, 1 lakh per month is the EMI, into 6 is equal to 6 lakh rupees FD you have to do with the bankers, which will be kept as a security, right? So this security banks can use in case of your default. If you default in repayment of EMIs, the banks can liquidate that FD and adjust the amount from your machinery term loans. So that was the concept and idea of machinery term loans. In the next video, we will discuss about building term loans. Thank you very much.